All right, good evening and welcome to the Canadian Association for Technical Analysis meeting. Today is December 22nd, 2022. My name is Blair Carruthers and I'm your host tonight. Tonight we have Mr. Keith Richards from ValueTrend Wealth Management with us. Now, Keith is probably well known to most of you, but I will just give a short bio so that we're all up to speed. Keith is the founder and portfolio manager for ValueTrend Wealth Management. He has been professionally engaged in the securities industry since 1990. He's well known for his appearances on TV as well as print. So BNN, and we have, of course, Globe and Mail and Reuters. So lots of experience that way. And he is also an author of the two books that I know for sure, Smart Bounce and Sideways. And he is a good, strong supporter of the old CSTA and with us tonight with CATA. So with that, I will just pop up the disclaimer. You can look at that. It should be the same disclaimer that you had when you signed in. Basically, it boils down to all the investment decisions you make are your own responsibility. This is just for information. And with that, I will stop my share of the screen. And Keith, it's all yours.
Okay, well, thanks for having me, guys. And I think I've talked to your formerly CSTA, now CATA group. Probably, what do you think, Blair? Probably half a dozen times anyways.
We've only been going for the year, so it's just you were one of our lead presenters with CATA. In prior, you were down in Oakville. Yeah, you presented to us, and with the other presentation you go to, yeah, you're a longtime supporter of both the organizations. Yeah.
Yeah. So, by the way, I've written a third book recently. So anybody that's, my specialty is actually in sentiment. When I got my CMT, I did the old-fashioned way. I wrote a thesis, a research paper. And I did it on contrarian investing, sentiment indicators. And so I finally decided, after like literally 25 years of using sentiment indicators, that I write a book on it. So there is a book that I've written. If anybody's interested in contrarian investing and sentiment indicators, it's kind of the go-to book, I think, for that arena. But so tonight we're going to talk about money management. And money management is something in past seminars I've done for the groups, it's always been, let's talk about how to use momentum indicators. Let's talk about what the market's going to do. Let's talk about trend indication and that kind of thing. But one of the requests I've had recently has been on money management techniques. And this came from a course. I put together a technical analysis course. Maybe some of you guys read my blog. So I sometimes mention I have this course, and people that have been reading my blog for a long time, I actually had an introductory pricing about a year ago on it, and people scored on that because it's now 4 times the price originally. I just did it for all my blog readers. But the course is pretty comprehensive. It's like A to Z's of how literally I, as a money manager, do things. So I condensed it to try to make sense for you guys as retail investors, but really it's probably the only course, I think, on the market anywhere that you can literally learn how professional money managers do things from A to Z, starting from the technicals that you guys know about, but the structure of how do you stop out and how do you enter, and the techniques of money management, allocations, and all the different rules that us guys, in order to be discretionary managers, when we apply to the Ontario Securities Commission to own and run a firm using a discretionary platform, we have to present to the OSC. Well, these are our systems. So this is my system that I've put together in a course. And today I'm going to present to you part of that course, and it's literally like about 1/18 of the course, so it's not a big chunk of it, but it's on sort of how do you position size and that kind of thing. So I hope you find this a little bit different. I hope it's going to be a little bit more valuable than some of the, okay, here's what a trend line looks like. I want to make this something that you maybe won't see from other presenters. So this is an excerpt from my course, but as I said, it's like 1/18 of the course. So you can see it's part 4, and I think there's something like 8 or 9 sections, and in each section it's broken down into different things. So this is a part 4, money management, and really what I want to talk about is 3 rules. So when we're developing a money management program, so how you are going to formulate your program on how you are buying and selling and how you are going to allocate your money and all that stuff, you actually have hard and fast rules that I'm going to ask you to create and write down these rules. So I'm very quantitative with the way I do things. So again, if you read my blog, you know that, hey, I've been in cash for most of this entire year, and I still am in cash. Why? Because one of my hard and fast rules, for example, from a trend following point of view, is if the market is not over the 200-day moving average, I've got to hold a lot of cash. And so guess what? It's been above the 200-day for a long time. So I'm holding lots of cash. So that's just an example of a quantitative rule. And you've got to do this with asset allocation and position sizing and hedging. And we're going to discuss what each one of these things mean and how you create these quantitative rules. And you're going to write them down, and your rules are going to be different than mine, because I'm a professional money manager. We're now managing well over 200 million just in our equity model. Like it's grown, and because it's getting bigger, we have to be act a little differently than, say, a retail investor that could maybe be a little bit more flexible, because they don't have to worry about discretion of compliance and all that stuff. But the concepts and the principles are the same. So let's get started on that. And let's try to identify asset allocation according to Investopedia. It's basically trying to balance risk and reward by apportioning your assets according to your goals, the risk tolerance, and the investment horizon. Okay. So let's take a look at that, because I'm going to carry it a step further than what the Investopedia says, by saying that we have rules for how we allocate between countries, sectors, how much cash we're going to hold, and in bear and bull markets, how much hedges we are allowed to hold. Okay, and beta. And some of you may know what it is. For those who don't, we're going to talk about it shortly, but it basically is how a stock moves or a sector moves versus the overall market. So if the market goes up 1% and you've got a beta of 1.2, then your stock or sector or whatever will go up 1.2% when the market goes up 1. But if the market falls 1%, you'll lose 1.2%. So that's beta. Okay. So we adjust beta. So you've got to have some rules. Well, how am I going to make those decisions? Like, how do I know how much I'm going to allocate to any sector? And it really comes down to, again, your goals, your risk tolerances. But if you don't have these spelled out, so I'm giving you examples here. So for example, and these are actually my rules. So we will not at ValueTrend have more than 30%. And that's an extreme. Like, we don't usually go 30%, but this is the maximum. It stops us from going all in, like a lot of people did during the FANGs, the Facebook, Apple, Netflix, whatever. So even if we wanted technology, we couldn't own more than 30% at any time. So it stops you from, getting too excited by any particular sector. We don't allow any more than 10% of our equity platform. This is specifically for our equity platform, not for our aggressive platform, which is a totally different animal. We can basically, it's almost like rule free, our aggressive platform, but that's why we call it aggressive. But our conservative equity platform, we say, look, You can own, we own lots of other countries. We've got a position in Brazil right now. We've traded Chile. I mean, we're in and out of China at times, the Chinese ETF, the market ETFs. So, but we can't have more than 10% in any country outside of North America. So we could have like 90% in the US, that's okay. But we're not going to have, even 12% in China, for example. So that's our rule. Doesn't mean it's the right rule for you, okay? But it's our rule. We also, use seasonal trading, and we always say, look, over the summer, no matter what, we tend to have an average cash weighting of 15%, adjusted using trend analysis, and we'll actually go about 5% on either side of that. Again, these are my rules. They're not your rules, but you can create rules like this. So maximum cash weighting, if all of our trend rules are in place and everything's trending up, the maximum cash we can hold is 5%. Okay, we're not allowed to hold over 5%. And we usually, of course, if the market's bullish, we usually only want a couple of percent. And by the way, you guys are retail investors, you don't need any cash if the market's up, but we have to have cash because sometimes you need cash for redemptions or whatever. We have a maximum cash weighting of 50% for markets. So that's been the case this year. We've been up to 40%, actually right up until about a month or so ago. We went down to 36 and now we're at 30 only because we think there's still room for a small wiggle pop at the end of the month, but I may be wrong on that. I'm still 30%. The point is that we can't go more than 50%, even when I got an all hands on deck alert. Again, if you read my blog, you would have read this on April 3rd. I do spell everything out that I am doing on the blog. I just don't give you my individual stocks. So it's been pretty valuable for investors over the years to follow what I am doing. But I went all alert in April and I went 40% cash and we adjusted the beta, like I was just saying, all the stocks that were left over in the portfolio, we adjusted beta right down to like 0.85 on the existing stocks. We didn't hedge with the exception of we bought a lot of non-correlated assets, like commodities and whatnot. But the point is that we had some rules. And why would we, for example, only have 50% maximum in a bear market? Why couldn't we go fully cash? Well, the reason is because we figure if we go over, this is again us, I'm not saying this is what you are going to do, but with us, if we say we're going to go 80% cash, then we're making a statement that we know that our analysis is so accurate and it just cannot be wrong. And I'm going to tell you, the minute you think that you actually know, rather than your weight of the evidence, which we use weight of the evidence using various trend and risk following rules, like the sentiment rules that my book is on, we use those, but we still recognize that, my gosh, we could actually be wrong because that's the market. You don't actually know what's going to happen. And anybody that thinks they know that's going to happen should come and work for me and I'll pay you $1 million starting salary a year, so long as you can prove it. And if you're wrong, you owe me $1 million back. Okay. So in other words, it keeps a limit on us, no matter how bearish we are. And we were pretty darn bearish this year, and rightly so, but we still couldn't go over 50. We went to 40, just FYI. But that's just, one of our rules. You guys need, Blair, you have this presentation. You can send it out to everybody. You guys need to create these rules for yourselves. With each, so when you say how much in the sector, well, this is how much exposure I'm going to have to a sector. And it might be 40, it might be 10, whatever you think. But once you've established that rule, that's what you got to stick to. And it's to save you from yourself. I created a little ditty years ago. This is a Keith Richards thing. So you're not allowed to, you have to give credit if you tell anybody this. I said, a system will save you from yourself. Okay. So this is part of my system, my actual system. And it saves me from myself because if I'm uber bullish or uber bearish, there's always rules to stop me from going, if I really like China, I can't put more than 10% in it, so that's saving me from myself. Like, what if you were bullish on Tesla, a couple of years ago? I mean, you've seen what the stock's done. Well, it's okay if maybe you had 5% in Tesla of your portfolio, but boy, if you had 50%, you'd be in deep trouble. And I'm telling you, a lot of people in the FANGs, Facebook, Apple, Amazon, Netflix, Google, they had their heads chopped off in the past year because they were just all in. And then they sold, of course, way too late. If you over leveraged to the NASDAQ, whatever. So this is why your rules will save you from yourself. So that's asset allocation. Then there's position sizing, Investopedia. It's basically the number of units held by in a particular security. Okay, so units could be percentage, and that's the way I look at it. These are actually my rules. Okay, and I'm going to keep emphasizing this is not your rules, and you don't need to use these percentages. This is just me. It works for us, and again, we're an institution, so we have certain risk models that we've promised the Ontario Securities Commission that that we stick to. So these are hard and fast rules for us because we presented them, and people sign off when they become a client of ours and say, yeah, I agree, you can do this. So these are our rules. We say that if we're going to own a stock, we are going to own it between 3 to 7%. The maximum we can hold is 7%. Now we are allowed to go under the 3, but we rarely do. We go as low as 2 sometimes. But so it's typically an average of 5%. Okay, so that's neutral weighting, as you can see on the third point here, is 5%. So obviously the difference between 3 and 7 is about 5. So we will, but if sometimes what will happen is a stock will go up a lot. And this actually happened to us tons of times over the past 33 years, but it happened to us not too long ago because we made a very good call. Thank you. Again, spelled out on my blog, end of 2020, when everybody else hated commodities, we called the Fed and the Bank of Canada and the transitory inflation, we called them BS. And we literally, you can go back on my blogs and you can see fall of 2020. I was like all over that saying they are totally wrong. And I was disagreeing with apparently the smartest banking people in the world, the Fed, but I won't get into why I knew they were wrong, but it was obvious. It was as obvious as gravity, okay, that they were dead wrong on the transitory inflation. So we went nuts on inflation, and we really bought an awful lot of commodities. So we were not allowed to have more than 30% in any one commodity, but we basically got up to about 70% in commodities. By the end of November, I think it was November, December of 2020. And of course, commodities were completely out of favor because of COVID, right? During the 2020 crash, we were buying oil at $40 and stuff, right? So anyways, what I'm pointing this out is because, again, we had to be careful with our positions. And so there were some positions that we just loved. I mean, we were really bullish on oil, and rightly so. It went from 40 to 100 at one point. We sold out a lot early this year, by the way, but that's another story. But these rules will keep you in check just in case you're wrong. So even if we had loved Tesla at some point, we wouldn't have been able to own more than 7%. And what happened with our position sizing is that we were holding a lot of oil. We held a lot of commodities of different types, but oil went quite bananas for a while there. And so some of our positions, we were buying 5% positions. They just were, so we were like doubling within months, a couple of them. And so they went to like 8%, if we own 5, and because they outperformed everything in the portfolio, because we also had staples and stuff, and they didn't perform as well. So, we had to sell. So our rules say you can't have more than 7. You might buy 5 and it goes to 7, that's fine. But if it goes to 8, you got to sell it. You got to sell 1% at least. So this is a way to keep yourself in check, take some profits, even if you still like the position. Okay. So that's position sizing. The last part is hedging. Okay. And William O'Neill, some of you might have read his great book. It was actually one of the very, very first proper books on investing I ever read when I first got into the industry. He influenced me a lot. He actually influenced me to become a technical analyst, because part of his, if you know his system, it's called CAN-SLIM, and one of the initials stands for the trend. Basically, he says that hedging is to offset the risk of an investment. And my way of looking at it is that it's insurance. And so actual car insurance is a good example. Like you're going to pay for your insurance, and you pay every year. Like, I don't know, let's pretend it's $500 a year for you to insure your car. Well, you get in no accidents for the next 10 years. You've just wasted $5,000. Okay. But it was there just in case. And so you have to accept insurance that it's going to be a drawdown in your portfolio unless it's not. And so if you you drive your car for 10 years, pay $500 a year, and then 1 year you just demolish the car and it's all your fault. So your insurance, it might be a $50,000, Volvo, and you just, for 10 years of paying $500 a year, you just got your whole Volvo replaced. So that's why you own insurance. It's if the market doesn't go down or whatever, then you feel like you're wasting your money, but maybe you're not. So it has a price, but you can't have your cake and eat it too. You can't have all the protection and none of the downside without a cost. And so it's going to drag on your portfolio. And not only because, if you're wrong with your timing, or even just that the market doesn't go down like you think. I mean, there's the management expenses, because a lot of hedges, which we'll talk about in a minute, have those expenses, transaction costs, and market inefficiencies, because there are no perfect hedges. All right. So there's pretty good hedges, but there's absolutely no perfect hedges. So how do you hedge a portfolio? I already mentioned beta. I mentioned that in the position, or sort of the asset allocation side of it. So remember, beta is just, and I don't know if I included this slide, but in my course, I include a slide from Yahoo, where you guys just, you don't need, like, I get FactSet, which is like $1 gazillion a month that we pay at ValueTrend to have all the fancy equipment. But you guys can go on Yahoo and then type in, I want a beta of less than, 0.85, and it'll actually tell you the stocks that are in that category. Okay. You can do 3-year beta, 5-year beta, whatever, and you can get a list of low beta stocks. So we adjust beta according to, and by the way, if we're bullish, so it's not just for a hedge. Like, let's say that you think, like, at some point this bear market's going to end. I don't think it's over for a bit, but it may have a rally into year end or something, maybe not, but and it'll probably wash out one last time and it'll form a bottom. And at that bottom point, and then you wait for the confirmation signals and all that stuff. That's another topic. But when that point that you want to start buying happens, I mean, maybe you want to start buying beta. Maybe you want stuff with 1.2 beta because you think the market's going to go up. You want to outperform the market, so you buy high beta, right? So adjusting beta according to what you think the market's going to do, including hedging, because again, I'm only allowed 50% cash. That means the other 50%, I still got to hold some stocks. So if I'm extremely bearish, and by the way, this year we were extremely bearish, and for good reason, because I was calling the BS by the Fed, and I knew I was right, and the trend was down, and the risk factors on my barometer were screaming, like lowest level in like 5 years. I hadn't seen a 0 rate on my barometer for years, and suddenly I was getting them like every single month. So everything was screaming bear to me. Okay. So we went cash, but we adjusted our beta like crazy. We bought all these staples and we bought all these, just stuff that wouldn't go down too much. Right. So that's another thing. And then you can also own negatively correlated assets. And we're going to get into that in a second, and non-correlated assets. So I'm going to explain the difference. So really quickly, beta, I just explained it. If you own a beta 0.8, which again, you can go on Yahoo and type in 0.8 beta, average 3 years, you'll find all the stocks that have had 0.8 beta over the past 3 years. Okay. But typically like utilities, staples, healthcare, telecom. Okay. High beta, that's technology, anything with growth, often like XBI, the biotech ETF, which we have in our aggressive account right now, just a little bit, but they're like high beta. Okay. Here it is. Okay. So I did put the screen from my course. So this is like, you go to Yahoo Finance Stock Screener, type in beta 5 years. You want 5 years because it gives you more of a picture of the beta price and the region. Whatever, you can go through all your parameters. I only want Canadian or whatever. And then you push go and it'll give you the list. Okay. So it's a great way of finding low beta stocks for beyond the cash that you've decided to hold. This is a way to reduce the risk or increase the risk because you may want 1.2 or 1.3 or 1.4 beta, right? So there's also hedging, which is the perfect way to hedge is negative correlation. So that means it moves opposite to the market. Okay, so it's going to move precisely opposite. And a single inverse ETF, and I produced some videos, and I actually just interviewed Jamie Purvis today. So this video will be released in a couple months, or a couple weeks, I should say. And he talked about the purpose with Horizons, and Horizons is like the leader in all these funky ETFs, like these really unique ETFs, and they basically brought inverse to Canada. And you get a bad reputation when you start talking about double inverse because of these double leverage, and you can lose your shirt. And you absolutely can. But the single inverse, they're not a bad vehicle. You still got to get your timing right. But I have used single inverses in our ValueTrend conservative platform because a single inverse is only going to perform with a beta negative one. So if you're like, you can say, well, I'm only going to hedge 5% of my portfolio. You create artificial cash by kind of offsetting 5% of your portfolio that's highly correlated to the market. And so you basically neutralize the two. And so that's a way of hedging. And you haven't made a bet on the market. You're just trying to, it's like raising cash without actually selling the stock. So I mean, these type of vehicles, this is a single inverse ETF. This is the Horizons one. And you can see this is several years of data. And you can still see that this line down here is the correlation line. So if it was here, it would be 0. There'd be no correlation. If it was here, it would be 1, there's a 1, that'd be 100% correlated. So when the two stocks, when the inverse moved, it would move up exactly like the market did, which is not what you want to do. And if it's right down to here, which is -1, that means perfectly negatively correlated. And basically, except for the odd blip, and that was the COVID crash where the inverses couldn't react as fast as the daily price movements. But even then, it was still pretty damn close to perfectly negative. It really, and this is after expenses. So these kind of vehicles, single inverse, if they do it well, they're a great way to offset. It's like creating artificial cash. So I'm not endorsing these things as something you should run out and buy. But if you want to raise cash, it's a good thing because you don't maybe want to take a capital gain on a stock you've held for a while. Well, why not just offset it? And guess what? If you're right about this stock or the market going down, you're going to make 0 because you're going to go, the inverse will go up and the stock will go down, or vice versa. If you're wrong and the stock goes up, and so your inverse is going to go down exactly the same. Well, so it did its job. Like, people are like, oh man, I made a mistake. No, you didn't. You simply hedged. Okay, so you got to understand, hedging is not about trying to make money. It's about trying not to lose money and accepting the fact that no matter what happens, at least with that portion of your portfolio, it's going to be a net 0 gain or loss. Okay, or very close to it. Like, it's almost impossibly perfect, but you can be close. Another negatively correlated asset. In fact, this is probably the best example of two assets that are negatively correlated is gold and the US dollar. Have you guys noticed lately the US dollar versus the world basket? What is it? The FSX or whatever it's called. I just call it the world basket all the time. The US dollar it peaked in August and it's been declining since. It happened with gold. It bottomed in August. It's been climbing ever since. Okay. So they're perfect. In fact, they're not perfect, but they're extremely, they're more often than not negatively correlated. So this is forget this line down here, but this is the correlation line. And you can see there's 0. So if it was 0, that would be no correlation. But you see almost all of the time, with very few exceptions, this line is negatively correlated. So that means that they move in opposite directions almost all the time, gold and the US dollar. So if you think the US dollar is going down, you probably have a good bet of making money on gold. And by the way, I will disclose, I own, right now we're already about 11% gold, and we're probably going to own more because we are very convinced that the US dollar's got much more room to fall over the coming year or so. So again, you can use it to make money. You can use it also to offset risk in financial assets like we're doing, because we think financial assets, meaning stocks, are largely going to not be so great. And so gold, which now has a chance of making some money against the US dollar, it's a good thing. But it's not a, gold is not a hedge against the market, by the way. People think, oh, buy gold because the market's going to go up. No, not at all. It's in fact, if you outlined the S&P versus gold, you'd find that the two are non-correlated. So there's negatively, and then there's not. In other words, they have no relationship. They're good diversification, if that's what you want. I'm a trend follower, so I don't want diversification. I want to only own what's going to be the right thing. But if you like that kind of model where you kind of modern portfolio theory, you want diversification, gold is good because it's non-correlated to the stock market, but it is negatively correlated to the dollar, the US dollar. Okay. So negatively correlated, I just give an example here. This is pretty easy math. You put $100, and assuming there's no such thing as fees. Okay. So you have $100 in an index ETF, which doesn't charge you fees, not possible. You also have $100 in an inverse ETF that is perfectly non-correlated, and they don't charge fees. Okay, this is a perfect world. The S&P falls 25%. So your index ETF is now worth $75. The inverse ETF went up 25%. So guess what? It's now worth 125. The opposite can also happen. But you see your $200 basically is worth the same no matter what the market did. So you bought $100 in the index ETF and $100 in this. Well, it doesn't matter what happened. You ended up with the same amount of money. Daily resets. Now you saw on that chart, here, that the inverse actually isn't too affected by daily resets, but you'll notice it's not exactly on the -1 line. There is a little bit of wiggle room, and that's because there are small inefficiencies. But nevertheless, with a single ETF, a single inverse, you can hold them for a little while, and the daily resets, you might end up, 2 or 3% off on versus what the market did, in the opposite direction. But it's not going to be like what I won't get into how leveraged ETFs inverses work because I don't use them. I don't recommend them anyways. So I'm not going to explain, but the daily reset hurts people that buy those and try to hold them for a while. Okay. But again, your timing has to be right no matter what, because you're going to be in it. If you do it like this example, $100 in each, you're creating effectively, you're making nothing all the time. So really, you don't want to do this forever. You just want to do it during times of your analysis has to be relatively correct most of the time to use these things, okay? Because you're at least creating cash. Okay, so non-correlated assets. We just looked at gold, okay? So there's no correlation to the vehicle. So if we're looking at the market, well, gold is non-correlated. They have no correlation with each other, okay? So it's like apples and oranges. So you buy a non-correlated for diversification only. You're not trying to offset because it doesn't offset. It's random, but still, it helps you not put too much money into any one sector. Although, as I said, I'm not a great believer in non-correlated investing. I just don't do it myself because I'm trying to be in the right sector. And if I can't find the right sectors, and I can always stop out if I'm wrong, and I can use negatively correlated assets to hedge anything that I don't feel like selling or I'm a little worried about. But nevertheless, that's how they work. So long bonds are generally non-correlated to stocks. And you can see that this is the correlation line. And you can see, remember how gold spent most of the time underneath when compared to the dollar? Well, this is up and down and up and down. So they have a little bit more often it's correlated. They're correlated to stocks, but they're also non-correlated enough that they're not always perfectly correlated. You can see that this is going up, this is going, flat, or there's a big peak here, not a big peak there. So, and they crossed here. So I'm just saying that it's a reasonable example of a non-correlated asset to stocks. So is gold. Okay. So market neutral versus the S&P 500. Now, market neutral, for some of you may be familiar with how this works. I won't get too complicated here, but basically what you do is you, and again, I don't do market neutral, but you can buy market neutral funds. This is the JP Morgan Market Neutral Fund. And what they do is they'll buy, say you're looking at banks and say they think that the JP Morgan is going to go up because they're more into financial assets, and Bank America is more into lending. They think that Bank America is going to underperform because the lending environment is bad. So I'm just making this up, but so you may go long JP Morgan and short Bank America. You know, they're both in the same sector. They tend to move more or less the same, but maybe JP Morgan will outperform Bank America. And therefore, if you do the long in the one that's the outperformer and the short in the other, you end up making a net profit spread. And what market neutral funds, if they're good, and the JP Morgan one is good. Okay, so you can see that when, you know, this is the 2008 crash, and you can see that fund first got cut up, but then it started making money because the good stuff was doing better than the ungood stuff, and they were picking the right stocks in that way. So a lot of the time the two markets move together, but there are times like here's 2020. Okay, the S&P, the red line fell, and the JP Morgan went up. Why? Because they were long the good stuff and short the bad stuff, and their judgment paid off. So sometimes market neutral can be a non-correlated investment. Sometimes it's correlated, but you're hoping that they're right at the right times when they're doing those spread trades. So that's how market neutral works. The only person that I know that in Canada that does market neutral, and he doesn't do it with 100% of the portfolio. But if you look at Brooke Thackeray's Horizon Seasonal ETF, he does some market neutral trading within his fund. Okay, but it's not a market neutral fund, but he does. So he'll say seasonally, this is, you know, something I want to go long on. This is something I want to go short on. So that's just, anyways, another way of diversifying. It's just, I'm introducing that to you. Again, I'm not much of a non-correlated kind of guy. I like being in or out or create cash. So this is your checklist. And this is kind of the grand finale here, that I'm hoping, like, if Blair, you hand out this presentation to people, that maybe you'll take this little thing here that I put up, and I'm going to ask you to state on a piece of paper, because this is what we have done for the Ontario Securities Commission, but I've been doing this way before we became an OSC firm. I've been doing this since literally the late 90s. And so you state your sector allocation, your minimum and maxims. You state the country allocations, minimum maxims. You state your position sizing. Remember, we talked about that, how much in a stock, what's your minimum, what's your maximum. You state your cash allocations. What's the maximum cash you can hold? What's the minimum cash you can hold? You state, now we didn't cover this because it's other parts in the course, but your entry and exit rules. Okay, what's your trigger? You know, how many, you know, what causes you to sell? What causes you to buy? And if you're wrong in a trade, what caused you to stop out? Like, and how are you going to stop out? You need to have these written down, and you know, state your policies regarding hedging vehicles, etc. So that's it for the rules. And again, I'm going to really try to influence you to make a list of these rules for yourself if you haven't already, and cover maybe you've made a list of some rules, but maybe you don't have all of those rules, like your position sizing and stuff. It will make all the difference in the world. It will make you far more like us in the professional game, because this is what we do. All right. And you know, it's a fact that on the whole, retail investors don't do as well as good portfolio managers. And by the way, we are positive on the year. So the market's down, what, 19 on the S&P, and I don't know, about 10 or something on the TSX. And last time we looked, which was 2 days ago, and yesterday the market went up, today the market went down. So we're going to neutralize all that. We were up about 3% net, but we'll see how we end up. But the point is, we're up, and most investors and most portfolio managers included are down, and it's in a big way, actually. And it's because we have all these rules, and our rules are pretty good. And our structure is pretty good. If you guys do these things we were just talking about, your structure will be good and you'll do well. So, and take my damn course, because honest to God, It will change your life. And I'm not even kidding you. It will make you much more efficient. And I'm not plugging it. I make my money managing portfolios. If you think getting a couple $100 or $400 or whatever it is off of you is going to make it's not how I make my living. So anyways, so I'm going to ask you 3 questions, and because we don't have the sound on, I'm just going to ask you the questions, and then maybe you got to write your answers down so you don't fool yourself that you're pretending you know. You go, oh, I knew that. So write down these answers. What's the difference between asset allocation and position sizing? All right. By the way, this is how my course works. So every single module, I do a quiz and then give you the answers after. Okay. It's a good way to learn. What's the difference between low beta stocks and non-correlated securities? Ooh, see, so I took you out of 2 different areas here. So third one is, what's the biggest downfall of a negatively correlated position when trying to hedge? What's the biggest downfall? It's not a perfect world. What could go wrong? All right, so maybe you write down your answer quickly, and then let's get to the answers. So let's see if you answered correctly. So asset allocation is big picture, right? We talked about this. It's minimum sector weightings, maximum sector weightings, cash weightings, position sizing, security weightings, all this stuff. So it's all about, your top-down view on your portfolio. The next question was, go back, sorry, it was the difference between low beta and non-correlated. So low beta, remember, 0.8, it moves 20% less than the market, up or down. And if it's a low beta stock, like 0.8 beta. Non-correlated stocks actually are the opposite. They have no relationship. So beta is the relationship to the market. Non-correlated stocks or non-correlated assets, like remember gold to the market, not gold to currency, because gold to currency is negative relationship, but there's no relationship. Okay. And then the third thing is, what's the downside of negatively correlated? So like an inverse. Okay. So what's the downfall? Because markets rise over time. So you better be right. Like, if you're going to make a 5-year bet on an inverse, I almost guarantee you that you're wrong. Okay. You're going to be dead wrong. Okay. Now I don't even recommend making a bet. I only recommend a hedge using these things against existing securities, but time is against you with making a negative bet on the market. I mean, can you imagine going short on anything for the next 5 years? Like, I mean, yeah, some of these stocks might go under, but most of the time, the market or in particular will go up over time. So that's the downfall. So your timing has to be pretty good. I mean, you don't have to be absolutely perfect, because in my way of doing things, you're just creating a neutral environment where you're not actually making or losing money if you do it well in the position that you've done. But still, who wants to make nothing forever? So, if you do it right, then you've hedged out your risk during a negative period, and then you can go back in. For example, just an example, but let's pretend that we all agree that after maybe a blip into the end of the year, maybe there won't be a blip up into the end of the year, I don't know, but then maybe let's all pretend that we all think that there's going to be one final washout in the market in the first quarter. So maybe we wait for some technical signals, and then because we don't want to sell some stocks, instead we just maybe buy an inverse. And if we're wrong, we're wrong. Okay, so we created a neutral situation. But if we're right and the market washes out, then we save some money. Okay, so it's a double-edged sword. You can't have all your profits and save all your downside. But the bottom line is that you've got to be pretty confident and understanding that you're really maybe giving up on potential returns. Okay, whenever you use a non-correlated hedge. So this was, I always do this what you have learned thing in the course. So this is, I bring you through what you have learned to the point of this part in the course. But just to give you an example of how my course works, the first section is on the basics, like understanding trend and all that stuff, money flow, moving averages. The next section is on macro analysis. So that includes the sentiment work that I do, plus, macro trend. And then I talk about how do you find candidates. And by the way, I've had people email me. I've had 300 people buy the course so far, and just I only opened it up to buying in January. So it's almost a year. We've had 300 people buy it. It's pretty cheap for what you get. We identify how do you find buy candidates, and this is one of the questions that retail people ask me a lot, because I know how I find them, but literally I've got a budget of, and I'm small, like we're a small shop. We only manage, less than $250 million. So, but we can still afford to spit out $50,000 on institutional research. You guys can't get institutional research. You get the garbage stuff from the banks, if that. So, and I mean, it's garbage. So the good stuff is these unique ideas and stuff like that. So I turn to that, as well as we do sector rotation models. Well, in my course, I talk about some things like the sector rotation model. I tell you exactly how it works and how we pick stocks. And also I give you ideas from things like that Yahoo thing, where you look for beta stocks and all these different ways of scanning. I even talk about some retail friendly analysis programs that might only cost you a couple $100, $300 a year. That's not bad. They do quant scanning and they're pretty good. By the way, VectorVest is not one of them. So I don't really like that one, but maybe some people are using it, but I never found it. I once bought it like a long time ago, and I just couldn't understand what people saw on it. But I recommend a few of them in my course. So that's a very important part of it. And developing a sell discipline, like how do you know when to sell? Money management, we just went over. So that was just one of the sectors. And then other considerations such as the Fed, Elliott wave, and stuff like that. So that's how the course is structured. And again, usually I try to influence people to become clients of ValueTrend, but it's a great way if you are a do-it-yourself investor, spend less than $400 and actually learn to do things like I do. And, I don't know how you've done this year, but we've made money, and we're an institution. It's harder for us than you, by the way, as small investors. So we've made money for our clients. And so anyways, that is it. I have a website, and you can find it more, including that online course. I write articles, and I write this blog, and some of you might subscribe to it. I just warn you, I've got a kind of a political one coming, because anybody who's known me for 13 seconds knows I don't much care for the current government, but we won't get into that. So I do a rant once a year on this blog. So it's about to come out. So maybe don't subscribe for another week or two, unless you like politics. And then videos, online technical course I just mentioned. And I tweet out stuff on Twitter and ENN and all that stuff. There's different ways you can kind of catch my analysis. The bottom line is, like, if you follow my blog, even tolerating my once a year political rant, if you follow my blog, like, I have steered people, and I get a lot of compliments on this. Like, I told people in 2020 I was buying commodities and that I didn't believe the Fed. I told people at the end of 21 that we were reducing our beta, and I told people on April 3rd, which is when I got my signal. I literally blogged that day and I said, I'm out. And so I told you at the same time I was doing it. So if nothing else, read the damn blog and tolerate my political rantings once in a while. The online course, it's $400. But if you contact me directly, I just did an offer for my blog readers, and I quit the offer, but I can reopen the offer. I just talked to my course producer guy, and we can create another discount code for you guys. So if you want to take the course, let me know. You have to shoot me an email, and I'll get a code for you, okay, from my producer. It'll go down to less than $300. And by the way, if my course saves you like one lousy trade or makes you more efficient on one good trade, the $300 is peanuts compared to what people regularly take as losses on stocks. And I've had literally been so many compliments. I did a show at the Money Show, and I literally had people come over and go, I took your course, best thing I ever did. And I've been told that many times. So I really do emphasize, if you're ever going to come to a guy like me to invest your money as a money manager, take the darn course, because it's really probably worth $10,000. Like, I'm not even joking. It's a very well thought out course. I really put my heart into it, And I really wanted to help people. As I said, I'm not in the business of selling courses. I would go broke at $300 a pop. Do the math. So I did it for retail investors to learn. So anyways, stop share. And now we're going to answer questions. So do you guys want me to do this verbally? Because I've got a whole pile of chat questions here. So how do you want me to do this?
Yeah, you can just respond to the chat questions first, and that will give people time to think of anything else. Actually,
Okay.
I'll read it out for you. So how do you define a bull market?
Okay. Well, of course, on the beginning of every answer, I'm going to say, take the damn course. But because I define all that stuff because there's hard and fast rules. Okay. Everything, like if I've got 33 years of doing this, and I'm going to tell you, if there's this, it comes back to that sentence, a system will save you from yourself. If you can get that into your cranial vault, have a flippin' system. I didn't use the F word. Have a system. Because if you don't have a system, you're spitting in the wind. Okay. So how do I define a bull market? I mean, really, honestly, take the course. But in my second book, Sideways, I describe the basic system. It's the trend system. The course outlines the risk system and everything. But let's just do the basics. On a weekly chart, higher peaks, higher troughs. Okay. 2 in a row is a minimum. That's an uptrend. Okay. A non-trending market, which doesn't mean a down market, is no more rising peaks and troughs. Okay, so it doesn't mean they're going down. It just means that, hey man, we either didn't make a new higher low or a new higher high. It could be one but not the other. But again, you know, if you read my second book, you can see this stuff. But you know, we now have some rules based on the weekly chart. Peaks and troughs got to be higher. As soon as they stop getting higher, then you have at least a consolidating market. And if you start seeing a concession of 2 lower highs and lower lows, then you've got a downtrend. Okay. By the way, the other part of my rules is a successive lower high, lower low, and this is the important part, and a break of the moving average. Okay. A break of the 200-day moving average. Now that's because that's my time frame, a midterm trader. Usually around 6 months or so. You know, I want to hold a stock for at least 6 months. So that's with stocks, but even on the market. So if you go back to my work early in 22, you can follow. You can't BS when you've got a blog because it's on the record, right? So you will see the beginning of the year I was calling for a bear, and then when it broke in April and I got the risk signal and it had already made a lower high and a lower low, I said, okay, guys, here's why I'm bearish. Go to my April 3rd blog and you'll see. So it was just all rule based. So that is my rules of how I defined a bull market or a bear market is rising peaks and troughs and a move above or again below the moving average. So hope that helps.
That does. Yeah, like you say, it's a system and you can reference it. That's great. Next question that came in, would you consider a 6-month duration corporate bond ETF about equivalent to a cash position?
Equivalent, probably not, but a reasonable, what do they say, a reasonable facsimile? I mean, cash is cash. Okay. So the only cash I consider cash is like at best a 30-day money market, or like, so to me, it's got to be wholly liquid, absolutely incapable of fluctuating. All right. So high interest savings accounts and cash are cash to me, but a 30-day T-bill is pretty much absolute. The further out in duration, the more potential for fluctuation. So but it's not that much fluctuation because it's only 6 months. So no, it's not cash. It's not the equivalent, but it's not bad. It's not a bad idea. So
Yeah. Okay. Now you covered part of this in the system or in the presentation, but on your position sizing and rebalancing, when do you do it and how often do you do it to adjust the position size?
Okay, take the course. Okay, and then
Yeah.
but really like, because our rules are hard and fast, we literally, like, I go over my stocks like minimum once a week. Like, so if I know, if a stock, for example, on position sizing, so I gave you the example, oil like exploded to the positive, unlike the pipeline recently. um, Oil exploded to the upside in our portfolio. And so we had these like way overweight positions. So we were peeling them back, and we just like literally, okay, we're over 7, and I'm looking at it at least once a week. So we just made the decision and we started peeling out. How often? It's really based on the movement. Now, having said that, we run this asset allocation model, which is in the course. And the allocation model is only one of our ways of buying and selling stocks. So it's not the whole system. But it's one of our important things because we're believers in sector rotation. So if we start to see that there's a movement out of sector A, and I'm going to give the commodities we started selling early 22. We had made a bloody fortune on them. When we think of when we bought late 20, and then we were like up a lot by the end of 21. And then we started seeing rotation out of them. Okay, so we started rotating out of them. And by basically the first quarter or so of 22, we had a lot less commodities. I think, we ended up with we were like, like at one point, like 60, 70%, it was huge, but we eventually got down to like 30 and then 20. And I think we ended up like 15% for most of the year. We're still believers in commodities, but we drastically reduced our positions. Okay, so how did we do it? We're always running our sector rotation model. It's not an absolute, but we run it as we start to see weakness in sectors. We go, I better run the model. So it's kind of like once a month, but it's not on the clock. The one thing I do on the clock is my risk, and it's on the blog, by the way. So I call it the barometer, and I do that absolutely same time every month. First or second business day of every month. Okay. And I report it on the blog, by the way. So I give you a risk reading, and it's for me too. I don't do it for you guys. You're not even paying me. but I do it for us, and then I report it on the blog. And so so just recently, the trend has remained bearish. We're below the 200-day. We've not made a new high. That we got to take out 3,400 on the S&P 500 before we take out that last peak. So we're still at best, we're in a consolidation right now, and we're still below the 200 days. So we are, as far as we're concerned, in still a bearish predicament. All right. So with that in mind, we then got a move up in the risk thing on December 3rd, but only up from 0, which is like run for the hills, to 2, which is still high risk. Like it doesn't enter into neutral until it hits 3. Okay. So we're still in high risk. So he said, yeah, but it was 0 and now it's 2. So maybe we go from 36% cash, which we were December 3rd, and we then moved into 30% cash, which, in hindsight, went up and then went down, and I don't know, we're probably no better for it. But anyways, that was our rule, is that if the barometer says, it's a 2, then we shouldn't really hold more than, and the trend is down, that we shouldn't hold more than 30. So we went back to 30. Okay. So right or wrong, that's what we did and what we have as our rule.
Well, that's good. And then we've had 3 people indicate that they're enjoying the course. They've bought the course and enjoyed it. So that's a good promotion there for it.
Good.
And like it. And Morley says, thanks for the information on referencing the moving average in the system. All right. So we can open it up now to anybody else that has questions. You can certainly feel free to unmute if you wanted to, or put it into the
Blair, somebody asked me if I'm available in October of 23 for Calgary in person. So if it's a conference with lots of people showing up, I might be tempted to come out. This was by Mark. So Mark, give me an email ahead of time, and certainly can consider doing that. I haven't been to Calgary for, I'm going to guess 25 years, so it might be kind of cool.
Well, hopefully in October, the temperature will improve from that minus 26 I was telling you about earlier.
So I'm telling you, I'm not coming in the winter.
Maybe I could come to Toronto and visit you instead.
Yeah, we can do the Calgary conference in Toronto.
But yeah, I think we'd love to. Well, I know we would love to have you out here if you've got clients to see in Calgary. That would be good if you could come and see us.
Sure. Yeah, we can figure something out.
I just threw that in.
Yeah,
I didn't mean to steal your thunder there, Blair.
Yeah, no problem.
that's all right, Mark. No problem there. We have one more question that came in is how often do you change your rules?
Change, I mean, the answer always is not. I don't, but that's not actually true because the rules have evolved. Like I actually patented the name ValueTrend when I was working for Wood Gundy. Like I was a stockbroker. I was one of the first guys in the company to get a portfolio manager's license, and I set this thing up. I wasn't with the OSC, they're IROC, Investment Regulatory Organization, and I became an IROC portfolio manager. I later became an Ontario Securities Commission, my own firm, right? But so I had some rules, and my claim to fame back then, by the way, was 08. I followed these basic trend following rules that I just mentioned, like break of the 200-day, break of the lower, and I got out, and the market fell 53% if you look at peak to trough in the S&P 500, and the TSX was pretty much the same, mostly because of Nortel. And I felt 26 point something. I recovered 100% of the capital by the first month of 2010, and the market didn't recover till 2013. So that was my first iteration, I guess you could say, of my rules, because it was strictly trend following rules. The barometer didn't exist at that time, although I was doing technical work. I told you I wrote my thesis many, many years ago, 99, I think it was, for the CSTA or for the CMT on sentiment. But my barometer there was simply two things. It was a put to call ratio combined with an RSI, and it was the early stages of what is now the barometer. So I would look at that, but it wasn't as integrated into my rules as it is now. Like we literally have, oh, okay, the trend's down. Well, here's how much cash we got to have. And oh, okay, the barometer is also saying scary, so we better have even more cash. And we have this little chart. Okay, so how often do I change my rules? Well, you're always learning, aren't you? I mean, we're all learning. And so one of the things that I've changed in recent years, and it really came about after observing what happened after 2010 with the Fed. And I mean, they're saying don't fight the Fed has been around forever, but really the Fed became far more involved, and let's face it, purposely manipulating the stock market, because they know that's part of liquidity. They know it. So they create the wealth effect or the non-wealth effect through their doings. So because the market became way more sensitive towards Federal Reserve policy, and I guess to a smaller extent BOC policy, Bank of Canada, but the Fed, it has taken a bigger role on the influence on markets than in the past. So we have had that influence our decisions. So Craig does the fundamentals, but we discuss it and we say, look, if the barometer says this and the trend says this, but the Fed is also right now going raise rates, it's another reason to get a little bit more tight, more cash, right? Now, we haven't established a firm rule because we're not sure how to quantify it. Is 25 basis points the trigger, or is it 50? We don't have a rule. I'm sorry for that. But I will tell you that that's changed in the past few years because we know it's affecting the markets. So we don't want to fight the Fed. So Craig and I, that is our qualitative side of our business. We discuss. So what do the minutes say, Craig? That's usually I'm like, how do you interpret the minute? I know what those other guys are saying, but how are you interpreting? What should we do? Should we go from 36 to 40 cash? Like, what are you thinking, Craig? And he'll give me his input, and then we'll butt heads a couple of times, and then we come to a decision. So there's a new change to our rules. We've got a qualitative side.
Yeah. That's good. Well, I certainly like the like you say, the system saves you from yourself. And it's good to see that you're not the only person that, or the private investor is not the only person to have getting in their own way to their success. So don't see any other questions coming in. Oh, here we go. One just came in. When investing in gold to hedge the US dollar, do you prefer to buy the miners or bullion?
Okay, and I also see a question when I was on BNN, one of my top picks was Barrick. So do I prefer miners or bullion? Actually, I got that very question on BNN, and the answer was all of the above. That's that's the answer on that. You always circle all of the above, and you're more likely to be right. So, and that is why. So we have gold. We have a gold bullion ETF, and we have one gold stock, which is ABX, and we have one diversified precious metal stock, which happens to be Wheaton. So Wheaton's been outperforming because they're a bit more heavy in silver. Silver's on fire right now. Gold has been just starting to recover, and so Barrick will likely pick up, and that's why. Whenever you're on BNN, you want to put your best foot forward. So you pick the one that you think between now and my next show, what's going to go up, because you want to look like a rock star, right? So and you only got 3 chances to be that rock star. So you always try to pick your best, at least I do. So cash, I know, because I'm pretty convinced the market's got another leg down, and I really can't go wrong with holding it. But the other two were picks that I felt have some upside. And the ABX, it's the host did call me out in this. Like the ABX is in a bit of a crappy trend, agreed. But the thing is that the miners have this. If you go back to my show, you'll see like the gold bullion itself has got this gorgeous long-term cup and handle, and it's just in the handle right now. And I'm going to tell you, like I've seen these suckers before, and when they break out, it's to the what did the Walt Disney movie to infinity and beyond. Remember what was that guy's name, the astronaut guy?
Yeah, Buzz. Yeah, Buzz Lightyear.
Buzz Lightyear. So
Yeah.
it's like to infinity and beyond. If gold breaks out of this handle, which is like $2,000 lid, so this is a big picture thing, but it could very easily get to 2,000. But if it breaks 2,000, I mean, by itself, a move to 2,000 isn't a bad trade, so I don't mind that. But if this sucker breaks 2,000, I'm telling you, to infinity and beyond, and that means Barrick and everybody else is just going to go bananas playing catch up because the producers are not as pretty looking as the bullion. Okay, so. I like Barrick for that. And yeah, we're at about 11 or 12% gold right now. We might be, I think it's about 11 or 12%. And I can probably tell you we'll be another 3 or 4% before you can say Bob's your uncle. So we're buying it in steps. We buy everything in steps. That's another thing I teach you in the course is you don't just go, I want gold, give me 20%. Like you have to have a system for legging in. And we have a very defined, which I present in the course, a very defined system on how you leg in. Okay. When this happens, you can buy another 2%. And when this happens, you can buy another 2%. But you got to have rules. And that way, because if the trade goes sour, you haven't put your entire position in, you've legged it. Okay. And it's okay to buy higher. As I try to explain the psychology of people, buying higher is okay. So, and somebody asked me, will I increase my percentage over 11%? Yes, I will. I just, I'm going to, probably going to 15. That's what I expect. So, do I have physical gold? No. We just use the ETFs. We're traders. And I get it. You can buy the Sprott thing. It's the closest thing to a tradable physical gold, I guess. I think it's Sprott. We just disclose who we bought. We got the Horizons Gold what is it? HUG, I think it is. Why? Because it's Canadian, it's listed on TSX, it's easy to get rid of. I mean, I could have bought the one on the US, but to me, it's just whatever, supporting a Canadian company, and it's all the same. They're all trading the same futures. So they're liquid. They have a good market maker. I mean, for our size, because we are trading, we've got a couple $100 million at least in our equity platform, and when you take a 5% position, now you do the math, you got $10 million. I got to have the liquidity, and I can go to the market maker and get out, no issues whatsoever on that. So, and I am a trader. Like I'm not married to gold. Gold bugs. I'm not a gold bug. I'm a nothing bug. I rent rooms by the hour. And I won't tell you the analogy there, but here for a good time, not a long time, as they say. Right? So, so, anyways, so hopefully, does that when investing in gold to hedge in US dollars, do you prefer to buy the miners? Yeah, well, sorry, that was kind of answered. So, if you're going to hedge the US dollar, buy the actual bullion. So that would be, because it's the absolutely negatively correlated asset. The miners, they can lag for better or for worse, because they can also outperform. So,
Yeah.
One of the comments I made on the show, by the way, is that, and this comes from Craig, I pretended to know fundamentals. I don't know anything about fundamentals. I mean, it's like PE. I think it stands for what you do when you go to the washroom. No, wait, it stands for price to earnings. But Craig, I said to Craig, give me some fundamentals in case the host asks me something about Barrick. God, I'm giving away too much here. So I always do this because I'm just looking at charts. I'm a pure charty, but CFA. So he's the real McCoy. He's a smart guy. So Craig, tell me about ABX, because he might ask me something beyond what the chart looks like. And so, yeah, we do this all the time. So he goes, well, and I go like, so really, why is Barrick lagging? Like I'm buying because I think it's moving up after a bottom of a trend. So he said, well, they need to have an $1,800 price on gold. So they start becoming profitable at 1,800. I go, well, by Jiminy, that's where gold is right now. And he goes, yeah. So if you're right, Keith, and gold goes to $2,000 at least at the top of that handle, then Barrick's, quite leveraged to that. So they'll actually have outperformance, right? Because they're kind of, everybody hates them because gold isn't 1,800, but well, it is now. But so that's kind of when you want to own a producer is as they move off of, say, what, somewhere around $1,800 as gold moves off of 1,800. Any comment on Earth? Yes, Earth minerals, lithium. Watch my video. See, I can't say take my course, but watch my video that I just produced with Jamie Purvis today. It'll be out in 2 weeks because we talked about that. But yeah, we hold we do have positions in uranium right now, like physical and in a stock. And we think these rare earth materials are going to be a place that we're going to buy more and more of. We have in our aggressive platform, we have, I think it's platinum. I mean, I just look at the tickers and the chart. I don't even know what the half they do half the time, but yeah, I think we have some lithium, we have some plutonium or platinum, one or the other, but we're getting into all these kind of rare things a little at a time, not so much in the conservative platform, but we do have some uranium in the conservative platform. Is there another leg down on copper, a comment on copper? Yeah, it's early stage. Like we made a fortune on the metals. We really did. I mean, I'm bragging, but we sold at a really good time, beginning of this year. And we're just FYI, we're starting to buy again. But remember, if I want 15% in metals, it doesn't mean I bought 15% today. It means I bought 2% today. And then I bought 2% maybe a month from now. I mean, depending on what the market's doing. So we just bought, we just bought a couple of metal positions. So I think where are we? I think we're 4% right now in two different, like spread between two different positions. I think one's an ETF and one's a stock. And yeah, I look, Craig and I will assess what's the downside, what's the upside technically. So I said, like if it goes here and it stays there, then I would actually add some more. If it breaks through this, I will add some more, that's, again, take the course to get into all that stuff. But we're stepping in because we can see that there is a little bit of money flow coming into the metals right now. So.
All right. Along that line, I'll ask, one of my favorites is the commitment of traders. Do you reference it as well?
Commitment of traders?
Yes.
I haven't used it. I mean, isn't it very similar, if I'm not mistaken, to commitment of traders is more like almost like just another momentum indicator I remember it's similar. Sorry, I haven't brushed up on commitment of traders, although I think I actually talked about it in my course. It's been a while. I'm sorry, I don't even remember what the components of that indicator are.
Well, yeah, it's the ongoing positions of the commercials, the non-commercials, or the large
right
funds, and
so it's
the
a money flow.
speculators.
Yeah, it was a money flow indicator. That's right. Yeah.
Yeah. So it might be very similar to a sentiment thing, and I've looked at it for off and on for years when I'm going to investing in things related to the commodities, and I find it helpful, but I find it also it's early. So
Yeah.
sometimes I just don't have the patience. I see the thing move and I'm trying to get in, and like you say, don't have a system, so I get in my own way.
Yeah, and that's the thing. The other thing is that there's like billions of indicators out there. And the problem is that, I've learned a few and how to use them. And I'm pretty adept at using the few that I use. The sentiment indicators too, there's so many. If you read my book, it's called Smart Money, Dumb Money. And I talk about like the new stuff. There is new kind of alternate, what do they call it? Alternative data. And like they count the number of cars in all the Walmart shopping centers at 12 noon versus 12 noon on December 22nd of 2022 versus 21 versus 20, and they've developed pattern. I mean, the cash registers, how many people are buying Black & Decker screwdrivers today versus the normal, like it's just insane the stuff they're doing for alternative data. I talk about all that, and you can buy it. You can buy this data. Like, I can, I mean, it's expensive, but I will buy it if I think it's worth it. But I'm not going to buy it and say buy a $20,000 research package on alternative data until I really feel comfortable that I can actually use it to my advantage. So you talk about commitment traders. I've run across it, and yes, I remember it was money flow of some sort, but I haven't studied it enough to say this I'm incorporating in my system. Doesn't mean I shouldn't, but that's keep it simple, stupid, as they say. So whatever works for you, if it ain't broke, don't fix it. There's all those little ditties.
Yep.
And I'm going to say that I'm always open to new ideas. But one day, one of the other technical guys that you probably know, he said, "Oh, I use what do they call them? The Japanese clouds, the Ishimushu, or whatever they're called, clouds." So I started studying them, right? And I'm like, okay, and I'm like,
yeah. Oh, it's got to be working for you. So if you figure out how to work with it, stick with it. So you can never say that indicator doesn't work, because if somebody's figured out how to use it, they've figured out how to use it.
That's it. Like, for example, I love candlesticks for my short-term stuff. It's like they're I know how to use them, but it doesn't mean that, like some people get so carried away, they learn every single candlestick. There's like 5 candlestick, and I talk about it in my course. There's 5 or 6 of them that actually work almost all the time. So I'm not going to worry about the other ones, that maybe sometimes almost kind of work. I just want to know which ones really work all the time or most of the time, and then I'll use them. It's pragmatic.
So, all right. Well, we've got two last questions, and then we'll let you go. We're holding you here past the normal time, but one was a question about oil. What do you see about oil on your charts?
Yeah. Well, I try not to spill oil on my charts. Oil. Okay, so oil's been kind of consolidating at around 80. I mean, it had that nice little peak, and it's just backed off. We just bought some gas, nat gas, but I'm talking 2%. And we have one oil stock left after selling like reams of them just like less than a year ago. We kept one, and it's done okay. But oil itself, I am very bullish on oil, but I only have like so far about 4% exposure, I guess you could say, and then 2% exposure to gas. So if you're saying you're bullish, it's because I haven't seen the breakouts and stuff that I want to see, but the setup is there. So I have blogged. If you go to my blog and there's a search and you type in oil, you'll see me talk about oil a lot. One of the reasons I'm going to use the F word, fundamental. One of the fundamental reasons why we like oil is because there's a few factors coming in. Number one is the restocking of the strategic petroleum reserves. They've got to do it. There's no ifs, ands, or buts. Okay. There's seasonality. Okay. Oil tends to be kind of crappy until February and then tends to take off. And there's a reason for that, because everybody goes driving on vacations and the oil producers stock up. So this is definitely going to happen this year, recession or not, people are still driving. And number 3, Saudi Arabia, this is some intel that I get. I subscribe to some research that AG Analytics, and they are expensive. I don't recommend retail people buy it, but they're political intel. And, I'm a little political sometimes on my rants, but this is not political. I hate Trudeau. This is more political, as in here's some political insights that you can use to invest with. And they were one of the people that helped me identify the opportunity in oil in late 2020, I might add. But they're saying, and they're just using their intel, and they look at literally like which diplomat is flying where, and they're like really sophisticated, actually, their algorithms. And they were saying that there is an above average chance, like they go on statistics because they don't actually know, there's an above average chance that Russia will launch some sort of an aggressive action in February. They actually chose February, okay? And it's, how do they come? I don't know, but they've been right a lot, these guys. And they say, okay, so therefore, you know, maybe you got to be looking at oil and whatnot, and it all lines up with the seasonality. It lines up with OPEC not wanting to sell oil for much less than $80 a barrel because they're not all that profitable. It lines up with restocking the strategic reserves, and the charts is as sideways as you know can be, right? So at some point, you guys know stagnation doesn't happen much on markets, right? Eventually, things happen, either up or down. So I'm going to say we're not entering aggressively in, but I'm waiting. I'm convinced that something's going to happen. But again, the system saves me from myself. So I just like, okay, you know, we're going to wait. I'm going to be patient. There's a little bit of bullishness look after the sell-off on gas recently. So I kind of took a small step there, but you know, just a 2%er. And like bottom line is that, so I'm ranting on about oil, but I think there's a case that can be made fundamentally now, and I won't move until the technicals agree, but I think they're going to come together in the next couple of 3 months. And if they do, it'll be just as explosive, maybe not quite as explosive from 40 to 100, but like, you know, I think it's going to have a good move, and there's good reason for a good move. Recession or not, everybody goes, what about recession? Well, yeah, but you didn't have a government restocking reserves that they drained. You didn't have OPEC saying, I'm not going to take anything less than $80. And you didn't have Russia invading Ukraine. That might happen in the winter aggressively. So there's all these factors that are different than a normal year when, yeah, recession comes along and nobody drives their car anymore. Well, there's other factors at play here, okay? So anyways, that's a heads up. That's not a trade recommendation right now at all. It's just be aware.
Yeah.
There you go. I'll send you $20,000 bill because that's what I pay for these guys. So I just give you some intel that, and again, they're not 100% accurate. It's just some intel. So, you know, take it for what you want.
Yes. Have the patience to wait for the signals.
Yeah, exactly.
All right, last question, and we'll let you go. On uranium, are you buying stocks like chemical or physical?
All of the above.
All of the above. Again, yep. Spread the risk and have access to it both. All right, well, Keith, that was fantastic. I've got the 2 books. I'll have to look for your third. On the sentiment, that would be an interesting read, I'm sure. And on behalf of CATA, we'd like to say thank you very much for taking the time to spend with us. I'm assuming you've got all your Christmas shopping done, and if not, you'll be out there in the snowbanks tomorrow trying to get it finished off.
Yeah. Well, I'm an Amazon fan. I mean, not the stock, but
yeah, that's been helpful. Yes, so we certainly appreciate you spending time with us tonight, and we love the comments that some of the members have on the course. So just a reminder, you can reach out to Keith directly to get that coupon. And with that, again, thank you very much for being with us. Have a Merry Christmas, Happy Holidays, and we will, I'm sure, be tasking you to come present to us again.
Okay. Well, thanks guys for having me, and we'll speak again.
All right. Thanks again, Keith.
Okay,
all right. Have a good night.
You too. Merry Christmas.
Yeah. All right. So after that excellent presentation, I will ask Mark if you have an update.
Well, just a weather update. It's still cold here. That was an excellent presentation. I was excited by that, and that's why I reached out to him with that private message saying, come to Calgary on the 14th of October. And that applies to everyone in our club. Come to Calgary, 14 October. There's so many airlines that are now coming to Calgary on apparently cheap flights. I haven't looked at any of them personally, but perhaps 14 October is somewhere where our members would like to come. Blair, maybe you've got some spare time.
Yeah, I'll have to see if I can get out there.
Yeah, speak to your wife.
Yeah. Well, maybe I
Fire
could-
up, fire up that airplane that's sitting
Yeah,
above your
that
left
one, yeah.
shoulder there. Put some gas in the tank and join all the others. But that's the only message I have for our members tonight. I'm so pleased that we've done well this year, our first full year as a club. Members will be looking forward to your email coming out, Blair, in January, asking us to sign up for another year, and the rate will be the same, everyone. It won't break your heart. We've got some top-notch speakers that come here, and the enthusiasm that we saw tonight is contagious. So as they would say on public TV, get your checkbook ready and send in some money, but you don't have to do it in this calendar year, 2022. Save that for January. And yeah, so I'm looking forward to our next year as a club, and we've got enthusiasm. We've got Peter and Ian are looking at speakers, and I don't think we've had a dud so far. What do you think, Blair?
I think we've had good ones every time. So
Yeah,
I hope everybody else feels the same way.
yeah, I hope so. I hope so. So those are my comments as the president, reporting to you from sunny and cold Calgary. And oh, it's not sunny right now. The sun went down. Yeah, we've got 8 hours of sunlight. I checked the weather forecast yesterday. We got 8 hours of sunlight here, but and those solar panels that the Greens say will save the world, it's not saving Calgary. They got no electricity coming out of them this week, and there's a breeze but not a wind. So the windmills, they're shivering and they're not moving. We're relying on natural gas here. And I was pleased with what Keith said on oil there. It's what I've been thinking all along. I thought something would break in December, but didn't happen. So February might be the time for oil.
Yeah.
Blair, thanks for hosting tonight. I'll close my camera and take my microphone off.
All right. Well, actually, now's a good time if people want. They can certainly unmute and turn the cameras on. We'll be Peter hopefully is getting ready to share his screen with the charts. We'll have a few minutes for that. And as he's doing that, I'll just let everybody know we have David Cox, one of our regulars to certainly Oakville area, but he's a strong supporter of the old CSTA and the CATA. David is presenting to us on January 10th of next year. And we have a name that I hadn't heard before on January 26th, Matt Pertalia. So he's from Trading Equilibrium. I just did a quick look online, and he's certainly got a number of interviews and stuff out on YouTube. So we'll have to check that out. And he is speaking on the 26th. So, all right, a little at 9:30. We still have a few people hanging about. That's great. So again, feel free to unmute and turn your cameras on if you'd like. And we can start going through the charts. Okay, so there we go, Peter. Yeah, so you got gold. We've got Keith's position up, so you can see gold there, the ABX. And this is Trend Spider. Yeah, go ahead, Peter.
I just thought I'd start with this one, given the all the talk about gold during the presentation. I don't know if you've got any chat coming in on things people want to see, Blair, or if you want to go through.
Not yet. So yeah, we should go just kind of quickly through the main indexes as normally what we do. So just yeah,
gold. Going to show oil as well. Gold and oil.
Yeah.
It's double, you know,
double bottoming there. Yeah.
I'm just trying to think if I got the. So here's the main in the main components of this of the index. So start up at the top here. So financials.
So starting to go sideways. Nice big range there. Well, 30 to 36.
Yeah, and I guess like last time we looked at these, the question is the bear market over or not? And we just heard Keith's view of that he thought there might be still some downside here. But as we go through these index, you'll see a lot of them have, it's almost like an inverse head and shoulders possibly, or definitely a consolidation for the last, for quite a while here. So you'll see a similar pattern in a lot of these. Real estate sector. I'll just flip through them, Blair, and then if we have any comments, people can. Communication sector. One of the weaker ones. Utilities.
Oh, that was a big drop, but
Consumer staples has been strong. Materials. Energy strong.
strong energy, yes.
Industrials, that's been the strong ones. You can see again the and then of course the technology is still the one that's been pounded the hardest and struggling to get moving here.
Yeah.
Consumer discretionary has been the weakest. And then finally the health sector has been strong.
Okay, so certainly you can open it up if people have anything that they would like to specifically see. We certainly can take a look at things. One thing I saw on Yahoo Finance, I think it was, oh, good night, Janet, that they were talking about how Amazon has gone back to its pre-COVID level, and Apple hasn't, but is still looking like it's weak. So,
well, here's Apple. Maybe I'll look at
maybe a weekly. Yeah. So the pre-COVID crash, probably around 80.
Man, COVID was that long ago.
Yeah.
It's still obviously far from its crash, but that's Apple. You said the other one was Amazon.
Amazon, yeah. So yeah, it was interesting to take a look at those today and see.
So very different than Apple, right?
Yes, yeah, the last last half of that chart. So that that discussion, the one guy was saying that he thought that again, more likely another leg down, and his target was around $100 for Apple. So he was figuring for the market to come down more. He said you've had a lot of these weaker stocks come down already, and back to the pre-COVID levels. He said he figures that your market leaders are going to have to do that as well. So his example was Apple, and he kind of figured, down to maybe the 100 level for move to Apple, and he figures at that point you'll start to get enough value that things will stabilize. So interesting.
I'm just gonna show Caterpillar here, like as we saw in the indices, right, where the techs are getting pounded, but the Dow and things like that are very strong, right? So you can
Mhm.
see like Caterpillar about to break out into new highs for since COVID.
It came down close to its lows, kind of low around 160, and the highs before that were kind of in the 140 to 160 range. So 140 to 150. So yeah, close in horseshoes. So we're not getting any input here on the chat, folks. If you have something that you'd like to see, we had been looking at, I'll look it up. One was a HUD Bay. I forget the symbol for that, Hudson Bay. And what was that? HBM.
Hud Bay?
Yep.
I think I got it, HBM here.
Yep. So that. There we go.
This is a weekly chart.
Yeah.
That could be everything else.
Yeah. Let's see. We've got higher high. Yeah, kind of hard to say. So I mean, it certainly looks like the downtrend has probably ended. So
Higher lows,
higher low, higher high. And then with Keith's definition, he was using the 200-day moving average for his stuff, more of an institutional thing. So don't know that you'd be above the 200-day on that just yet, but
add it.
moving average with variable period. Oh, I guess it's just in at the level of the 200 there. So yeah, close. So that might be something that Keith's information might start to take a look at.
What type of mining is it?
I think it's several. I think copper is one. I think they do copper and silver. Is one that we'd had suggested to us. I'm not sure. Scott, was that one of the ones that you had mentioned before? And again, folks, this
Which
is the
one?
time. Hudson
Sorry,
Bay.
which one? Yeah,
Hudson.
I think it's got copper potential. Somebody else was talking about it too.
Yeah.
HBO?
HBM, yeah.
HBM, sorry.
Okay. And another one we looked at was HBI. Haynes Brands, yeah.
Yeah, we were looking at that basing a couple of months ago and it's probably still dragging on the bottom.
Yeah, still dragging down. Yeah, so hasn't turned the corner yet. All right.
I'll give you an interesting one here.
The other one we looked at was KSS. Oh, and I keep getting the name wrong. It's not, is it Kohl's or Kroger?
Coles.
Kohl's, yeah.
Yeah,
So that's still not bottoming.
making new lows today, so
Yeah. Okay. Here's a symbol, MDGLO. So Mike, David, Golf, Lima, Oscar.
The .o. MDGL on the O exchange, wherever that is.
Oh, MDGL.O. Okay, so
Yeah.
.o. Yeah.
is this it or is it something else?
So the pharmaceuticals, Scott?
The pharmaceutical.
Okay.
I'll read what I wrote on the screen in my note if you haven't seen it. The other day I ran a screen and came up with MDGL.O. When I opened it up for a quote the next morning, it had moved quite a bit, as the chart will show. It definitely got a wave on me before I could buy. Don't I wish? Look at that.
Holy. So they probably had something pass on FDA or something.
They did a beautiful test on a disease. It just like crippled just about.
Yeah.
But it's a shock when your screen comes up and before you can even make a thought on it, it's gone. But it proves technicals work.
Mm-hmm.
I just thought it was an interesting event.
Okay. Did you look at nat gas, Peter? You'd
NZ?
gold and
What
oil,
is it?
so you can try NG. No, sorry, that's natural gas. That's the commodity signal. UNL.
Right. Ouch.
Well, yeah.
Good short.
Yeah, big move down today.
It's last week.
Mm-hmm. I'm surprised with the polar vortex coming in. I would have thought the demand for natural gas would have pumped the price higher, but all right. Okay. Kim has asked for silver using FVI, Fox Victor India. Silver. Oh, yeah, look at silver there. Yeah. As Keith said, silver's been on fire. Yeah. So.
Yes, it is interesting. You might look at silver versus gold, right?
Yeah. Back to highs in August.
Silver.
Mm-hmm. I don't have my records as to when I started buying the silver, but yes, I'm certainly enjoying the piece silver that I've got. So yeah, silver's certainly moving. Can we take a look at FVI, Fox Victor India? Is that first?
The Canadian?
It might have been the .UN, might have been the units. I'm not sure. So FBI.UN, I thought. I saw that last time. Oh, could be Fortuna, yeah. Yeah, kind of reacting like silver itself. That might be a good substitute.
Yeah. Well,
Yeah,
going from $3 to $5.50 is a nicer move.
yeah, yeah.
Almost a double.
Yeah, that's good. Now, I will say I haven't looked. I think I looked at it the other day. And the commitment of traders, of course, with the move that strong, the commitment of traders usually has a massive change. Just popping it up on my screen here, but I'm pretty sure it's gone. Yeah, so it's it's not as bad as I thought. It's kind of middle of the road. So it's gone from the extreme long for the commercials to middle of its range over the last year. So still could be some momentum left in the silver. And I'm kind of in the idea that Keith was saying that with the US dollar and with gold moving, I think silver is going to continue to move. But it's certainly one of those things that I've got my stops in place in case it does turn around. And as it moves up, I'll be moving my stops up behind it. Because if it starts to go sideways, then it might be time to reduce the size of the position and look for another opportunity. US dollar moving down.
Just look at the major indices, so the NASDAQ. So again, hasn't made a new low. It was a brutal week this week with a little bit of a pullback here, but
Yeah, we'll have to see what the next couple of days bring, but it'll be that's the thing I don't like about having orders in the market when it gets a bit thin like this. The volatility, they could go stop hunting.
so interesting. I wonder. I'll look at a shorter. What happened at the end of the day here? So nice. Made a new low and
Brought it back.
tomorrow will be interesting.
Yeah. Well, here's a question for folks. And what do you trade the same in this holiday time, or do you scale back size, or do you avoid it altogether? Anybody want to comment on that? I mean, I usually in longer term positions, it's just if I from my days when I was trading the commodities, I got burned a couple of times in thin markets where you'd put a stop in and they take that price to your stop, you get stopped out, and then it turns around and goes your way. The expensive one was lumber for me. So I decided that I would not trade those, and I would not put the orders in through the broker. That was before I was trading with IB, Interactive Brokers. When I was trading with them, I had decided to avoid lumber market for sure, but I didn't have any issues because the stops were held, if I remember correctly, the stops were held on the IB servers, and they waited till the market hit it for the stop to get triggered. So a different way of doing it that was held in IB unbeknownst to the traders on the floor. So just a little different.
Scott, I like to buy in these markets, but not to sell.
Oh yeah. Yes, yeah, the opportunity might be there if it moves in your favor.
Yeah, I was looking for a stock the other day and I grabbed 130,000 shares very quickly. That sometimes I might have only got to fill a 5 or 10, but this time of year, somebody was probably doing a tax sale.
Yeah, gives you the chance to do that. That's a good point. Okay. All right, we only got a few minutes left. Anybody have any last requests to see?
I like UEC. It may be a little early, but I really think it's going to have a good year. Uranium.
UAC?
UEC. Uranium Energy Corp.
Well, certainly a long base there.
As you can see, it really moves when it takes off. It's one of the leaders in the uranium area.
So very
condensed, yeah.
well, sure had a nice bounce here.
Yeah, well, I'm kind of hoping that that's the start of the next year.
Just maybe get a bit of a pullback here and a good opportunity to get on.
Yeah.
And it's a reasonable price. I mean, you can afford to get 1,000 or 2 or 3 or 4 rather than the expensive ones.
Yeah, it's nice because the percentage moves are much nicer as well. It doesn't take a whole lot to get some decent
No.
return.
And it's got lots of liquidity, so you can get in and out pretty easy in the US, a lot of volume.
Yeah, I like that one.
I think you'll like it even better next year.
Well, yeah, again, I'm more of a longer term trader, so
The targets they're giving on this stock, I forget the latest, they're around $8 or $10 US. That's the current targets.
yeah. Oh, good stuff. All right. Well, 9:57 folks on my clock. I know we got started a couple minutes late with Keith because we had lots of good conversation going. But for those of you in the Ontario area, we got that storm bearing down on us. So it looks like we'll probably end up with a white Christmas. And Mark is gone, but oh no, Mark's still there. So I know you guys said it was clear and cold out there. Was it so fast that did you guys actually get white?
Sorry, I missed what you said there, Blair. I was listening to something else.
Yeah, no, I was just saying that we have in Ontario here, we've got the storm bearing down on us. We're likely to have a white Christmas. So I didn't know if you guys were white out there or is it just too clear and cold?
Oh, it's cold and clear, but white.
Okay.
They're forecasting on Christmas Day 0 Celsius, so it might be slushy, but that's better than -32.
Yeah. Well, it's not so bad. The kids will appreciate having the snow there for Christmas, so at least to wake up to it on Sunday morning. And if nothing else, they can go out and roll the slushy stuff into a snowman.
For sure.
Remember, Mark, out west, it's a dry cold.
Yeah, something about that. Yeah.
Cold is cold.
So when it's dry, I take whiskey. That takes care of my dry throat too.
Oh, brother. With honey?
Oh, I got lots of honey. I have no Coca-Cola, so I'm having a beer tonight. No whiskey and Coke for me tonight.
Okay.
Thanks again tonight, Blair, for hosting, and thanks everyone for coming.
Yeah, you're welcome, everyone. So yes, all right. Sorry, Scott, we didn't have time for fine, but we'll.
I wasn't looking for you to do find. I was responding to a comment on the board.
Okay, no problem. All right. Well, certainly appreciate you being here, folks. Just a reminders, next year, woohoo! Next year we have on January 10th, David Cox. He's now with Raymond James, and on January 26th, Matt Pertalia from Trading Equilibrium. So those are speakers that we have lined up, and that's updated on the website, so you can actually see it there. And after that, we will say thank you very much for being here with us tonight. It's nice to have a good showing. And on behalf of the Canadian Association for Technical Analysis, we'd like to wish you all a Merry Christmas and Happy Holidays. And most importantly, a prosperous new year. And hopefully one of these stocks that we can get into will make it prosperous for everybody. And again, thanks for coming out. We appreciate you coming. So good luck, good trading, good night, and Merry Christmas to all, and to all a good night.
Thanks, Blair.
You're welcome. Thanks, Peter.